Hey everybody, thanks for joining me today. I normally talk about stocks I think are gonna, do great, or stocks that are in my portfolio that I've, held for a long time and have been really good investments. Today I'm gonna go the other way. I'm gonna talk about the three stocks in my portfolio that have performed the worst since I bought them and what I think about them now. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube, and you'll get some great information. Again, fool.com/Frankel. So let's get right into it. I want to share my screen real quick. Okay, so these stocks are down anywhere from 40 to 63% from where I bought them. Now, that's from my overall cost basis. In some cases, I bought some, it went down, I bought some more, it went down, I bought some more. That's definitely the case with at least one of them that I'll talk more about in a minute. So this is like from my average cost basis. This is not necessarily the stock's overall performance, which over the past few years is much worse in all three cases. I didn't buy any of these, thankfully, at the peak. So I'm in better shape than a lot of people who invested in these stocks, but they are still down quite a bit. So without further delay, number one, and this is the worst of the three, is Lemonade, an insurance company. They offer primarily homeowners, renters, and pet insurance. They're just getting into the car insurance business. They offer some life insurance products. They are the worst performer in my portfolio. I've only bought Lemonade stock once, and it's down 63% from where I bought it. The company is yet to turn a profit. There are some significant concerns about its business model, specifically its reliance on reinsurance. It's kind of it's the charitable aspect of the business is definitely a good thing, but there's a lot of concern about whether that's a viable long-term business model to donate your excess profits to charity. As noble as it is, I definitely applaud them for doing that. The company is not profitable yet, even on an adjusted basis. But there is a lot to like about Lemonade at the current price. The company, for example, is net cash flow positive and expects to continue to be, with the exception of the fourth quarter of this year. If you're not familiar, insurance is a somewhat seasonal business. And if there's a lot of natural disasters or a particularly harsh winter, it can be bad for the business. So returns are kind of lumpy in this one, but they say they are going to be net cash flow positive from here on out for the most part. The company has $931 million in cash on its balance sheet. That's not much less than its entire market cap. So you're getting this business very, very cheaply, and they expect that to only really dip by 1 to 2% from current levels before continuing to climb for the foreseeable future. They've done a great job of getting their loss ratio down closer to their 75% target, meaning 75% of the money they take in premiums is being paid out as claims. That's gone from 92% to 79% over the past few years, steadily declining. And there's a lot of potential to grow the business, especially in auto insurance. So Lemonade is, on the right track. The business, I would argue, is stronger than when I bought it, but it's a different environment. They went public at a time when money was essentially free. They issued a lot of convertible preferred stock at a 0%, or convertible debt at a 0% interest rate. And it was really easy to raise growth capital. That's not necessarily the case today. So it makes sense why the stock is down, but I think it's a little bit overblown. This is one that I am holding on to. I like the business. I'm not adding any to it, but I like the business. Number two, and this is the best performing of the three, if that doesn't say much for these three stocks, this is Boston Omaha, and this is my largest position out of the three. This is the one that I was talking about where I've added to several times. I'm down about 40% overall on my entire cost basis on Boston Omaha. This is a holding company. If you're not familiar, they own billboards. They have an insurance business. They have a broadband internet infrastructure business, and they have a few minority investments, including a pretty significant stake in another publicly traded company called Sky Harbor. SKYH is the ticker for that one. Which the Sky Harbor investment's really been the only thing to like in the past 2 years. There really hasn't been much else in the business that's made me happy with how management's executed over the past 2 years. There was a fourth business line called Boston Omaha Asset Management that surprisingly is being wound down. the company had a plan to start raising third-party capital to invest on behalf of its investors and to make some fee income on things like built-for-rent housing, which it made some pretty lofty claims that it was going to raise money, do built-for-rent housing, eventually spin it off as a real estate investment trust. That it saw a 400 million opportunity to invest in broadband buildouts. It completely failed to raise any capital, gain any traction on that. Abruptly shut down the business earlier this year. The CEOs, because of kind of a technicality, received a massive compensation package a couple years ago that really wasn't warranted and would be excessive even if the company was doing well, which it isn't. The company is running low on cash. It's surprisingly low on cash considering its business model. Its broadband assets in particular haven't really performed up to expectations, at least not yet. And last but certainly not least, one of its two co-CEOs left recently, right shortly after getting that big compensation package, decided that he wanted to move on to other opportunities, and got a big buyout in the process, and it's just been kind of a mess. Really, the only positive, other than the Sky Harbor investment that I was talking about, is that there's two positives. The new now sole CEO is making good moves. His transparency is up, which has been one of my biggest complaints, is that poor communications with shareholders. That seems to be turning around. You started a buyback program. We'll see in a few months if they actually bought back any stock. And really, the biggest reason I still own this company is simply because there's no case I can make where the sum of the valuation of the parts is less than the valuation of the stock. In other words, it's trading for a significant discount to its intrinsic value, and that's really the biggest reason I still own it. I'm really in show me mode with Boston Omaha at this point. I'm going to give Adam Peterson, who's the CEO, who's running it by himself now, I'm going to give him a year or so to start showing me some serious progress. But other than that, this is the one of the three. If I was likely to sell one of these within the next year, it would probably be Boston Omaha at this point. It's been that much of a disappointment for me, management-wise. Number 3 is Nextdoor. They're the social network. A lot of people don't even realize it's a publicly traded company. Ticker symbol is KIND, KIND. Down 42% from my cost basis. This was a SPAC IPO. It's down about 75% from its initial $10 per share SPAC price. It's down for a reason. The growth has been kind of sluggish. Until recently, it was led by a CEO named Sarah Fryer, who came to prominence because she was the CFO of Square at the time the Cash App was being built out. Did a fantastic job. She was honestly one of the reasons I bought the stock in the first place. But she really had a really tough time getting out of the growth at all costs mentality. Didn't really do much for cost controls, was just prioritizing growth, not prioritizing efficiency. And you really can't do that in an environment like this. The company's co-founder recently returned as CEO, which is great. His priority is efficient growth, getting capital allocation right while still growing revenue. And it looks like it's working. In the second quarter, user growth, revenue growth, and adjusted EBITDA margin growth all accelerated from previous levels. They're projecting 11% annual revenue growth this year, which in a difficult environment is pretty solid. They expect to become cash flow positive in the fourth quarter, which would have been kind of a crazy thing to predict a year ago with this company, with how much money they were kind of hemorrhaging. Nextdoor is a very cash-rich business because they went public by SPAC at the right time. They have about $450 million of cash and no debt, and about a $900 million market cap. So about half of the entire market cap is in cash. They're buying back stock aggressively right now. They bought back 5% of their outstanding shares in the second quarter alone. A lot of potential value here. They're still in the early stages of figuring out how to effectively monetize their platform, but I'm very happy with the progress, especially in the past couple of quarters. I've added to my position, and this is the one of the 3 that I am most comfortable buying and building my position in right now. I'd love to hear which of the 3 do you think I should get rid of? Should I add to what are some of your bad investments that you still like for the long term. I do my best to respond to all your comments individually, and thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.